Good? Then lock in, because this is not background noise content. This is the kind of video you sit down for, the kind you replay, the kind you wish you had watched before you made a decision you can't undo. Let me say this as clearly as I possibly can, right up front, for every American investor watching this. Do not buy a single ounce of silver in February until you understand what actually happened in January. And I don't mean the headlines, I don't mean the price chart, I don't mean what your broker, your favorite Twitter account, or cable news anchor told you happened. I mean the real story. The plumbing, the incentives, the traps. Because what we just lived through was not a normal rally, and it was not a normal crash. It was a stress test. It was a sorting mechanism. It was the market very deliberately separating people who understand how capital actually moves from people who just chase price. And if you think that sounds dramatic, let me remind you what just happened. In the span of 1 month, silver went from the low 70s to over $120 an ounce, and then collapsed more than 30% in less than 24 hours. A 70% rally and a historic crash in the same week. That does not happen by accident. That does not happen randomly. That happens when leverage, policy, psychology, and structural supply collide all at once. History is probably going to call this Silver Thursday 2.0. The survivors will remember it as the moment they finally understood how this market really works. And the casualties, the people who bought the top or got wiped out on leverage, are the ones who didn't take the time to study what you were about to learn. And here's the uncomfortable truth. February is not where you get rich in silver. February is where mistakes get punished. So if you're watching this because you're thinking, should I buy at 85? Should I wait for 75? Is the bull market over? Was that the top? Or was that just the beginning? Then you're exactly where you need to be. But before we talk about February, before we talk about price targets, support levels, or scenarios, we need to reconstruct the crime scene. Because January was not one move. It was 3 completely different markets masquerading as one. And if you don't know which phase you're in, you will always end up being liquidity for someone else. Now, before we go any further, I want to pause for a second, not for the algorithm, not for engagement tricks, but because something important is happening here. The silver market is not a US story. It's not a Wall Street story. It's global. And the people who understand it best are usually the ones watching this stuff at strange hours from different parts of the world, trying to connect dots that mainstream finance never even mentions. So take 2 seconds, drop a comment. Where are you watching from? And what time is it right now? Are you in New York watching this before the market opens? Are you on the West Coast catching this late at night? Are you overseas, up way too early or way too late because January messed with your portfolio and you're trying to figure out what comes next? I read those comments. And more importantly, the smartest insights in this community usually come from people comparing notes across time zones. Now let's get to work. To understand January, you have to see it as a 3-act story. Act 1 is the buildup from January 1st through about January 20th. This is the phase where fundamentals mattered, where the price was moving for real reasons, where smart money was positioning quietly. Act 2 is the euphoria, roughly January 21st through January 29th. This is where the move goes parabolic, psychology takes over, and the market starts rewarding speed instead of discipline. And Act 3 is the slaughter, January 30th and 31st. When leverage meets reality, liquidity disappears, and the market reminds everyone that it does not care how strong your conviction is if you are on the wrong side of forced selling. Today, in part 1, we're going to live inside Act 1, because this is where most people already get it wrong. Act 1 began quietly, almost boringly. On January the 2nd, 2026, silver opened the year trading around $71 and change per ounce. After a monster 2025 that had already delivered gains north of 170%, most investors expected consolidation, maybe a pause, maybe some digestion. The first trading session popped about 4%, pushing silver into the mid-70s, which felt normal, healthy even. Traders were back from the holidays, liquidity was returning. Nothing about that move screamed mania. But here's what most American investors missed at the time. The real story of January did not start in New York or London. It started in Beijing. On January 1st, 2026, while most people were still thinking about fireworks and football games, China quietly flipped a switch that changed the global silver market. Silver was reclassified. No longer treated as just another industrial commodity, silver was officially placed into China's strategic materials framework, the same category as rare earths and other critical inputs that Beijing explicitly manages for national interest. This wasn't a surprise if you were paying attention. The policy had been telegraphed late in 2025, but markets have a habit of ignoring slow burn risks until the moment they become unavoidable. Under the new rules, silver exporters now required government licenses. The number of approved exporters was slashed from over 100 companies to just 44. Let me explain why that matters. In plain English, China mines roughly 13% of the world's silver, but that's not the key number. China controls somewhere between 60 and 70% of global silver refining capacity. That means even silver that S mined elsewhere often passes through Chinese refineries before it becomes usable industrial metal. When China says, "We are prioritizing domestic consumption," the rest of the world doesn't get to vote. And the timing was not accidental. The United States and China were already locked in an escalating trade conflict over technology, tariffs, and supply chains. Beijing had been signaling for months that it was willing to weaponize materials critical to electric vehicles, solar panels, electronics, and military applications. Silver sits at the center of all of that. By 2024, nearly 30% of global silver demand came from China's solar photovoltaic industry alone. 10 years earlier, that number was barely over 10%. Beijing was not about to let foreign buyers outbid domestic manufacturers for a material that underpins its energy transition and technological ambitions. The market felt this immediately. In Shanghai, silver began trading at premiums over New York and London benchmarks that made no sense under normal conditions. What's typical? Maybe 50 cents to $1 an ounce. By mid-January, those premiums were $5 to $8. By the end of the month, they would explode even higher. That widening gap was the first real warning sign. It told you that arbitrage, the mechanism that normally keeps global prices aligned, was breaking down. And arbitrage only breaks when physical metal can't move fast enough to close the gap. At the same time, something else was happening back in the US that almost nobody outside the metals world was paying attention to. COMEX inventories were bleeding, not slowly, not gradually, violently. In the first week of January alone, over 33 million ounces of silver were withdrawn from COMEX warehouses. That was more than a quarter of registered inventory. The silver actually available for delivery against futures contracts, gone in 7 trading days. On January 7th, over 3 million ounces left the vaults in a single day. 0 came in. By mid-January, registered inventory sat near 108 million ounces. That's a 50-year low. Now here's the number that should make you uncomfortable if you trade paper silver. At the same time, inventories were collapsing. Open interest in the March delivery month represented claims on roughly 500 million ounces of silver. Do the math. Hundreds of paper claims for every physical ounce. This wasn't a Reddit squeeze. This wasn't meme speculation. This was industrial users, bullion banks, and large players quietly demanding delivery instead of rolling contracts forward. Even JP Morgan, a name that always shows up in silver conversations, issued delivery notices for over 8 million ounces on a single day, accounting for nearly all delivery activity. And here's the subtle but crucial signal that most people missed. Traders were rolling backward. Instead of rolling January contracts forward into March, they were pulling delivery earlier. That tells you they didn't want price exposure. They wanted metal. This wasn't froth. This was stress. Zoom out and the picture gets even clearer. The global silver market had already been in deficit for 5 consecutive years. From 2021 through 2025, cumulative shortfalls totaled roughly 800 million ounces. Those deficits weren't solved. They were papered over by drawing down above-ground inventories. Now add China's export controls to that equation, and suddenly the Western market realizes it can T-count on Asian refining capacity to plug the gap anymore. This is why Act 1 matters. From January 1st through about January 20th, silver's price action was actually rational. The metal moved from the low 70s into the high 70s, then into the low 80s as COMEX withdrawals accelerated. It tested new highs in the upper 80s and low 90s, pulled back on profit-taking, and then stabilized again. Even the gold to silver ratio was behaving normally, compressing slightly as silver outperformed gold, but not in a way that screamed bubble. This is the phase where institutions accumulate. This is the phase where smart money builds positions without ringing bells. And if you bought silver during this period, you were buying for the right reasons. But here's the mistake most people make. They assume that because Act 1 was real, Act 2 must also be real. They extrapolate fundamentals into perpetuity, and that's where this market gets dangerous. Because fundamentals don't end bull markets, positioning does. And that's where we're going next. In part 2, going to walk directly into the moment when silver stopped being about supply and demand and started being about psychology, leverage, and speed. We're going to talk about the parabolic move, the dollar comments, the Fed pause, the Shanghai premium explosion, and the exact moment retail mania took control. And I want you thinking about one question before you watch the next part. At what point does a good trade turn into a bad decision? Because that question is the difference between surviving this market and becoming a cautionary tale. All right, if you're still here, that already tells me something about you. Most people check out once the price action gets uncomfortable. They want a headline, they want a number, they want someone to tell them, just buy here or just sell there. That's not what this is. Because Act 2 is where silver stopped being a market and started becoming a psychological experiment. And if you've ever wondered how otherwise intelligent investors end up buying tops, ignoring warning signs, and convincing themselves that this time is different, this is the part you need to understand. Act 2 begins quietly, almost deceptively around January 21st. Up to this point, silver's rally had been strong, but it was still explainable. Supply was tight. Comex inventories were draining. China had effectively put a floor under physical demand. None of that had changed. What did change was the speed. Between January 21st and January 29th, silver added roughly $26 an ounce in 8 trading sessions. Read that again. $26 in 8 days. That is not price discovery. That is not the market calmly digesting new information. That is momentum feeding on itself. And the most important thing to understand here is that markets don't T-flip from rational to irrational all at once. There's a transition zone, a gray area where fundamentals still exist, but they're no longer driving marginal buyers. That's exactly where silver was in late January. The first psychological line in the sand was $100 an ounce. That number doesn't matter mathematically, but it matters enormously emotionally. Triple digits change behavior. When silver broke above $100 on January 23rd, for the first time in history, it wasn't just a technical breakout. It was a narrative breakout. Algorithms that had been programmed to respond to round number momentum flipped from passive to aggressive. Media outlets that had ignored silver for years suddenly needed a story. Retail investors who hadn't looked at the metal space since 2021 felt like they were missing something important. The move from 90 to 100 took about 10 days. The move from 100 to 110 took 1 trading session. That's when you should have started to feel uneasy, because when an asset accelerates after clearing a psychological level, it's usually not because new information entered the system. It's because fear of missing out did. By January 26th, silver was trading north of $115. Intraday, it pushed close to 118. And here's a detail that matters more than most people realize. The daily candle printed on January 26th was a textbook shooting star. A long upper wick, a small, real body, clear rejection at higher prices. For technicians, that pattern doesn't guarantee a reversal. But when it appears after a parabolic move, it's a warning. It's the market telling you that buyers are starting to hesitate, even as price is still rising. That signal was ignored. Why? Because during Act 2, signals are inconvenient. They don't fit the narrative. And narratives are incredibly powerful when money is being made fast. Now, zoom out for a second. At this point, silver was trading more than 100% above its 200-day moving average. That level of overextension was worse than the 2011 peak, worse than 1980 on some measures. And yet, participation was increasing, not decreasing. That's your second warning sign. Healthy bull markets climb a wall of worry. Speculative blow-offs climb a wall of applause. And the applause was getting loud. Then came the macro accelerants. On January 27th, President Trump was asked by reporters whether the US dollar had fallen too much. His response was casual, almost flippant. He said he thought the dollar was doing great. Markets heard something very different. They heard permission. Within minutes, the dollar index fell to its weakest level since early 2022. For precious metals traders, this mattered enormously. A weak dollar isn't just a tailwind for gold and silver, it's a signal about policy priorities. It tells you that the administration is willing to tolerate currency weakness to support manufacturing, exports, and growth. That's historically bullish for hard assets. Silver surged another $7 that day, the largest single-day gain since 1980. But here's the key point. This move wasn't driven by new supply data or industrial demand numbers. It was driven by expectations about policy. Expectations are fragile. The very next day, January 28th, the Federal Reserve held its FOMC meeting. Rates were left unchanged after 3 consecutive cuts totaling 75 basis points. On paper, that's a pause, but markets don't trade the decision. They trade the tone. Powell removed language suggesting that labor market risks outweighed inflation risks. That signaled a subtle shift. But he also left the door open to future cuts if conditions warranted. Silver traders heard dovish neutrality. The metal rallied another $6 in after-hours trading, pushing decisively above 115. Now, add one more ingredient. China. As the Lunar New Year approached, Chinese buyers scrambled to secure physical silver before the Shanghai Futures Exchange shut down for a full week in mid-February. Domestic prices in China exploded. Silver traded at premiums of $12 to $14 over New York prices. Under normal conditions, that gap would collapse quickly through arbitrage. This time, it didn't. Export controls, tight inventories, and shipping delays made it impossible to move metal fast enough to capture the spread. This was the clearest sign yet that the physical market was under stress. But instead of grounding the rally, it fueled it. Because now, the story wasn't just about price, it was about scarcity. And scarcity narratives are rocket fuel for speculative behavior. That's when retail arrived in force. On January 26th and 27th, the iShares Silver Trust, SLV, recorded the largest single-day inflow in its history, more than $170 million. Trading volume exploded to levels that exceeded NVIDIA. Think about that. In a market obsessed with artificial intelligence, silver briefly stole the spotlight. This wasn't institutions rebalancing portfolios. This was individuals chasing momentum. Social media filled with screenshots of massive gains. Silver was being compared to GameStop. Influencers started talking about squeezes and moon targets. Mining stocks surged even faster than the metal. And here's the question I want you to sit with. When everyone around you is making money fast, how do you know when to stop? Because that's the moment that defines Act 2. On January 29th, silver surged to a new all-time high, touching $121 and change in early New York trading. The gold-to-silver ratio compressed into the mid-40s, a level only seen during extreme periods like 2011. Major banks published breathless research notes. Targets of $150 were floated. The language shifted from cautious to celebratory. For a brief moment, silver felt unstoppable. And that's exactly when it became most vulnerable. Because Act 2 always ends the same way. Not with bad news, with a change in expectations. In Part 3, we're going to walk through the exact sequence of events that turned euphoria into panic almost overnight. The Fed chair nomination, the dollar spike, the yield shock, the margin calls, the forced liquidations, and we're going to talk about why silver doesn't crash like gold, it collapses. Because once you understand that mechanism, February starts to make a lot more sense. Stay with me. If Act 2 was about belief, Act 3 was about gravity. This is the part of the story that almost nobody tells correctly because crashes make people emotional, and emotional people look for villains, conspiracies, or simple explanations. But what happened at the end of January wasn't chaos. It was mechanics. Cold, impersonal, unavoidable mechanics. And if you understand those mechanics, you stop being shocked by silver crashes. You start expecting them. Act 3 begins the evening of January 29th, when silver still felt invincible. The metal had just printed a new all-time high. Social feeds were euphoric. Mining stocks were screaming higher. The narrative was airtight. China demand, dollar weakness, Fed dovishness, structural deficits. Then, after the market closed, something subtle but deadly hit the tape. President Trump hinted that he would announce his nominee for the next Federal Reserve chair the following morning. At first, that sounds like political noise, but markets are forward-looking, and they don't wait for confirmation. Overnight, betting markets lit up. One name surged to the top with overwhelming probability: Kevin Warsh. If you've been around macro markets long enough, you know exactly why that mattered. Warsh isn't some obscure academic. He served as a Fed governor during the 2008 financial crisis. He's known as a hawk relative to recent Fed leadership. He has publicly criticized prolonged easy money policies. In other words, he represents the opposite of what silver traders were betting on. By the time Asia handed trading off to Europe, markets were already repricing the future. At around 7 o'clock Eastern on Friday morning, Trump made it official. Kevin Warsh was the nominee. That single announcement detonated the easy money trade. The dollar spiked, Treasury yields surged, real rates jumped. And that last point is crucial. Silver doesn't trade on nominal rates. It trades on real rates, the return you get after inflation. When real rates rise, holding a non-yielding asset becomes more expensive. So while retail was still celebrating Thursday's highs, the macro backdrop had flipped completely. But here's where it gets worse. The political shock hit the front door. The financial shock came through the back. On the same evening, Microsoft reported earnings. The company beat revenue estimates, but warned that growth in its Azure cloud business was slowing and that margins would be pressured by massive AI-related capital expenditures. The stock dropped more than 10% the next day, its worst single-day decline since March 2020. That mattered far beyond Microsoft, because hedge funds and family offices had been running leveraged positions across multiple asset classes: long tech, long metals, long momentum. When tech cracked, margin calls didn't ask which assets you loved. They asked which assets you could sell. Silver, thin and volatile, became a source of instant liquidity. Gold fell about 6%. Silver collapsed. Once selling started, it fed on itself. Algorithms that had chased the rally now amplified the decline. Stop losses triggered, liquidity evaporated, and then the coup de grace. On the evening of January 29th, the CME announced an 18% increase in initial margin requirements for silver futures, effective immediately. If that sounds technical, let me translate. Anyone holding a leveraged silver position suddenly needed to post tens of thousands of dollars in additional collateral per contract, immediately. This wasn't a suggestion, it was an ultimatum. For traders already underwater from the overnight move, there was no choice: sell or be liquidated. This is exactly what happened in 1980 with the Hunt brothers. Different players, same mechanism. By the time U.S. markets opened on January 30th, the damage was unavoidable. Silver went into free fall. From overnight levels near 117, it plunged to the mid-80s within hours. Some platforms briefly printed prices in the low 70s during intraday air pockets. By the end of the day, silver had suffered its worst single-day percentage decline in nearly half a century. And the pain didn't stop in New York. In India, where silver trading is deeply embedded in regional economies, dozens of firms declared insolvency. Traders who had been short silver, convinced prices could never go that high, were wiped out just as thoroughly as late-stage bulls. This wasn't a bull versus bear story. It was a leverage story. Anyone who was overexposed on either side got crushed. By January 31st, silver closed the month around $85 an ounce. Despite the carnage, it was still up nearly 20% for January. That's how violent the move had been. Now here's the lesson most people miss. The crash did not invalidate the fundamentals. China's export controls didn't disappear. The structural deficit didn't vanish. COMEX inventories didn't magically refill. What changed was positioning. Too many people were leaning the same way, at the same time, with too much leverage. When the macro narrative shifted, there was no buffer. This is why silver is not gold. Gold is held primarily as a monetary asset. It's deep, it's liquid, it's slow. Silver is half money, half industrial metal, and fully emotional. It moves further in both directions. That's why it outperforms in bull markets and underperforms in crashes. Now we need to talk about what comes next. Because February is not just another month on the calendar, it's historically one of the most dangerous periods for silver. Seasonality turns negative. Liquidity thins. China steps away for the Lunar New Year. And now, the Fed path looks less friendly. In Part 4, we're going to map out February in detail. The support levels that matter. The scenarios that make sense. The difference between accumulation and speculation. And most importantly, what an average American investor should do, and absolutely should not do, after a month like January. Because the bull market isn't over. But the easy part is, if you've made it this far, you're already ahead of the vast majority of people who participate in the silver market. Because Part 4 is where emotion gets stripped away and replaced with decision-making. This is where we stop reacting to what just happened and start positioning for what comes next. And I want to be very clear about something right at the start. February is not a month for hero trades in silver. It never has been. February is a month that punishes impatience, leverage, and certainty. It rewards discipline, humility, and planning. So let's slow this down and walk through it carefully. Because the biggest mistake investors make after a violent move is assuming that the next move must be equally dramatic in the same direction. Markets don't work like that. They move in phases. Expansion, exhaustion, contraction, digestion. January was expansion and exhaustion compressed into 1 month. February is digestion. And digestion is uncomfortable because it feels like nothing is happening while everything important is happening under the surface. Let's start with the technical reality, not because charts predict the future, but because they show you where behavior is likely to change. The January monthly candle closed with a massive upper wick. That's not a coincidence. That's a record of rejection. It shows you that buyers were willing to pay extreme prices, but they could not sustain them. Historically, when silver prints a candle like that after a parabolic advance, the next phase is not continuation. It's consolidation or correction, not because the story is wrong, but because the positioning is wrong. On the daily chart, the warning was already there on January 26th with that shooting star candle near the highs. Within 96 hours, the market proved that signal correct. Now the question everyone asks is simple. Where is support? And the answer is more nuanced than most people want. The first zone is the $80 to $85 range. This is where price stabilized after the crash. Its former resistance turned support. It's where dip buyers initially showed up. If silver holds this zone, it tells you that long-term participants are stepping in and that forced selling has largely run its course. But holding doesn't mean bouncing straight back to 100. It means grinding, chopping, wearing people out. Below that, the 75 to 78 zone matters. That's roughly the 50% retracement of the January move. Markets love symmetry. They love retracing half of an emotional move before deciding what comes next. If silver trades into that zone, it doesn't mean the bull market is over. It means excess has been further flushed out. Below 75, you start asking harder questions. The 70 to 72 range was the opening level for January. Losing that would signal that the market needs more time. Not that the long-term thesis has failed, but that patience will be required. On the upside, resistance is now obvious. 95 to 100 is psychological and technical resistance. Reclaiming 100 would restore momentum, but doing that in February without a new catalyst is historically unlikely. The 110 to 115 zone is where the final parabolic phase began. That area is now heavy with trapped supply. Anyone who bought there and didn't sell will be looking to get out on rallies. And the all-time high around 121 is not something you should be thinking about right now. That's not pessimism, that's realism. Now let's talk about something even more important than charts: seasonality. Silver has one of the most consistent seasonal patterns of any major asset, and February is statistically one of its weakest months. Over the last decade, short positions in February have been profitable about 80% of the time. Going back even further, the February through April window has produced declines far more often than advances. Even during the great precious metals bull market of the 2000s, silver frequently struggled during this period. Why? Because January pulls forward demand, because Chinese markets close for Lunar New Year, because industrial fabrication slows in the Northern Hemisphere winter, because traders take profits after January moves. Seasonality doesn't tell you what must happen. It tells you what usually happens. Ignoring it is like ignoring weather forecasts, because you don't like rain. This year, seasonality is colliding with macro headwinds. The Warsh nomination changed expectations. Even if rate cuts eventually return, the timeline just got pushed out. Real rates matter. A stronger dollar matters. Higher yields matter. They don't kill silver, but they slow it down. Add to that the fact that leverage was not fully purged in January. Yes, there was a massive liquidation, but open interest remains elevated. Speculative positioning is still high relative to historical norms. That tells you the market may need one more shakeout to fully reset. This is where opinions diverge. The bullish camp argues that the structural deficit is real and unresolved, that China's export controls are permanent, not temporary, that industrial demand, especially from energy transition and defense, will keep tightening supply. They're not wrong. The bearish camp argues that prices overshot reality, that solar demand may have peaked, that $120 silver pulled years of future demand into the present, that mean reversion points closer to 60 or 70. They're not insane either. The truth is, in between. Silver doesn't move in straight lines. It moves in violent bursts followed by frustrating pauses. So what does all of this mean for an average American investor? It means this is not the time to chase. It means this is not the time to use leverage. It means this is not the time to bet your entire thesis on what silver does in the next 2 weeks. February is a month for process, not predictions. If you believe in silver long term, this is where you think in terms of accumulation, not all in entries. You ask yourself questions like, if silver trades sideways for 3 months, am I okay with that? If it dips into the 70s, do I panic or do I plan? If it rallies to 95 and stalls, do I chase or wait? These questions matter more than price targets, because the people who survive silver bull markets are the ones who buy the lowest tick or sell the highest tick. They're the ones who stay solvent, stay patient, and stay disciplined through the boring parts. And here's the most important thing I want you to take away from this entire series. January was not a failure. It was a preview. It showed you what silver can do when supply tightness, policy shifts, and psychology align. It also showed you what silver does when leverage gets ahead of itself. The bull market is not dead, but the easy money phase is over. From here on out, gains will be earned, not gifted. So before you click away, I want you to do one thing. Be honest with yourself. What is your plan for February? Are you waiting patiently? Are you scaling in slowly? Are you sitting in cash and watching? Are you accumulating regardless of price because you understand your time horizon? Write it down, even if you don't share it, because silver doesn't reward conviction alone. It rewards preparation. And this market is about to test a lot of people who thought January was the hard part. It wasn't. January was the invitation. February is the exam.